Great, okay. Let's talk about the market because I got to be honest, I know it's starting to look ugly here, but it's holding up reasonably well considering all of the anxiety that's in the air. Of course, what we do is we follow crude. Every morning you wake up, first thing you do is you check crude prices. It's an indicator of where maybe the conflict is or how long it might take to end. So this morning, a big spike in crude. Obviously, that means we open lower. But for a moment, a split second there, we were coming together a little bit. Some of the indices came back, almost went green. That's because Reuters reported that a senior Iranian official said that there was still no agreement or arrangement yet for negotiations, but did note that diplomacy had not stopped, adding that if realism prevails in Washington, a path forward may still be found. So the street looked at that as being pretty good. I do want to say this. Deutsche Bank put out this really intriguing survey. Investors expecting a ceasefire. Now, right now, this is March, the month of March. It's only 3%. So, okay, it's only a few days left. 51% think in April that we'll get some sort of a ceasefire. And if not, then another 22% say May. So that's a large swath of the stock market right now, participants in the market who are thinking this will, it's going to be over at some point relatively soon, although the new time clock for when wars is supposed to end in days and not weeks. Still, that's encouraging. Of course, we know the longer that the clock ticks, the worse things can get. Now, I love this chart. This is from BCA Research. We keep getting all these taco charts and when President Trump's going to blink and all of this kind of nonsense. This is all about Iran, right? Iran's eventual capitulation point, because ultimately they will have to capitulate one way or the other. P is pain, C is them losing complete control of the strait. So this is where we are right now, where Iran must negotiate. They have to negotiate to avoid getting to X. This is the point of no return. So this is where we are right now. When we get to this point where there's a global recession and every country is upset with Iran. Already we see every single day a new nation, even the European nations are saying, we're going to get involved. We're going to do something. When you get to this point, we have a global recession. This green line is Iran's ability to close the Strait of Hormuz. It goes down more and more and more to the point they won't have any ability to do it. One way or the other, they will lose complete, total control. It would mean complete, total pain. So the clock is ticking for Iran. There's no taco trade here. Iran will have to blink one way or the other at some point, okay? In the meantime, something interesting happened this week. The retail investors kind of flipped the script. Now, this is according to Vanda Research. On Monday, this little dot here, on Monday, was the first time we saw net selling of single stocks since November of 2023. 2023 is a long time. Of course, the trend had been in place for some time. This is sort of the peak. We've been going down, but to go negative, wow, that's really, really pretty impressive in a sense that, they're not buying, right? They don't always buy. Now, this is a more granular look at it. And the reason I wanted to use this chart is from JP Morgan. What did they buy? What have investors been buying? Well, just two things. The orange represents staples, and the blue, this purple blue thing, that's technology, mostly Mag 7 names. So those are your safe havens. We know staples are traditionally a safe haven, and now Mag 7, even though they've been under pressure, considered a safe haven. Now, with that in mind, it's not just retail investors. Tech buying from clients at Bank of America, absolutely through the roof. Look at this. This goes back 20 years. This is huge. So there's a lot of buying on the dip that's been happening over the past 4 years. You don't necessarily see it because there's a lot of selling as well. But still, this means I think this is smart money, folks. I think it's smart money. And it makes sense, right? But I do continue to worry because the other part of this, the other so-called safe areas, folks, not necessarily that safe. Check this out. So defensive, they're expensive. This is the PEG ratio. So if you look at right now, what's most expensive, not share price, but this is price and earnings based on divided by growth. Utilities, staples, healthcare. If you're rushing into these areas looking for a traditional safe haven, you may be paying way too much money. So that circles us back to the Mag 7. If people are buying them, why are they going down? What's going wrong? Obviously, the more it goes down, the more it amplifies the bear case. And you can see all of them now with double-digit losses from below their peak, anywhere from 14% to almost 30% in the case of Microsoft. So a lot of pulling, a lot of tugging, a lot of confusion. But I think we're going to be okay.